FHA mortgages are the most common type of mortgage used by first-time homebuyers. As a matter of fact, nearly 75% of first-time homebuyers utilized FHA financing to purchase their first home. But FHA financing is not only for first-time homebuyers. You could have owned a home in the past and still use an FHA mortgage to purchase your next home. The reason people use FHA financing is because it allows for a lower down payment and it has easier credit requirements for qualifying. Today, we're going to talk about the difference between an FHA mortgage and a conventional mortgage. We're also going to talk about what those credit requirements are and why they're more lax with FHA financing. We're going to talk about ways to get money toward your down payment in a form of gift funds and what's allowed. We're also going to talk about interested party contributions, which are contributions from individuals involved with the transaction. And we're going to talk about ways to finance your closing costs into the loan versus what you should expect if you don't finance your closing costs into the loan. So let's get right into this. FHA financing versus conventional financing. Well, let's talk about some of the big differences. FHA, you can have a credit score as low as 580 and put down only 3.5%. And if you have a lower than 580 credit score, all the way down to 500, you may still be able to qualify for an FHA mortgage with 10% down. Now, as I said, the minimum down payment for an FHA mortgage is 3.5% of the purchase price. The mandatory mortgage insurance on FHA loans cannot be canceled. So that would be a negative part about FHA financing. Anytime you buy a home and you put down less than 20%, with a conventional loan, you're going to pay mortgage insurance. With FHA, the same thing applies, but it's regardless of the amount of your down payment. And it cannot go away simply by getting enough equity in the property. And they're more lenient on the debt to income ratio. So the amount of money you make monthly in relation to your monthly expenses can be higher on an FHA mortgage than it can on a conventional mortgage. So now let's talk about conventional just in comparison. So the minimum credit score on a conventional loan is 620, which is 40 points higher than the minimum credit score with a low down payment using an FHA mortgage. The minimum down payment, if you're a first-time home buyer on a conventional mortgage, is 3%. So it's a little bit lower than FHA, but in order to do that, you need to be a first-time home buyer. It requires mortgage insurance, as I mentioned, when you put less than 20% down. That mortgage insurance, however, can be canceled once you have enough equity in the property, meaning once you have 20% equity in that home, the mortgage insurance can go away. And the debt ratio can't go quite as high as the FHA mortgage. You're going to be capped at 50.4%, which is rounded down to 50%. So a conventional financing with low down payments and a high debt ratio is typically difficult to obtain. And in those cases, you'd want to look at the FHA option instead. Now, credit, we talked about the credit score going down to a 580 with 3.5% down, 500 with 10% or more down. So let's look into this in a little more detail. So you're buying a primary residence, which is a requirement in order to get FHA financing, meaning you're buying a home that you're going to live in. So when you're buying a home you're going to live in, FHA financing, 3.5% down, then we know that you need to have a 580 credit score to utilize that. As I mentioned before, 500 credit score with 10% down is a possibility, but it requires a lot of extenuating circumstances. Typically, if your credit score is below 580, it's because you have recent late payments or collections and so forth, which makes it very, very difficult to obtain the financing, although the guidelines allow you to go that low. So just be careful. The best thing to do, and something that we like to do with our clients, is review the credit in detail and see what's keeping the score on the lower end and figure out ways to improve those scores, whether it's having collections that are reporting incorrectly on your credit removed, catching up on payments you might be behind on, paying down balances. There's always a better way to approach things than just settling for what you feel you have to do, which would be, if you're below 580, having to put 10% down and figure out other solutions around the guidelines to make it work. Now, you might have a lower credit score because you had some sort of derogatory credit items or call it foreclosure, bankruptcy, or deed in lieu, short sale in the past, where now you're trying to buy again. Well, the waiting periods to purchase a property after those types of derogatory credit situations have happened is a lot shorter than conventional. So a lot of people have filed bankruptcy when they've had extenuating circumstances involving credit, where they've had businesses that might have had to be shut down during COVID, right? A lot of things could have led to their needing to file bankruptcy. And so the waiting period after filing bankruptcy on an FHA mortgage, if it was a Chapter 7, meaning that you filed and everything was discharged, you didn't make monthly payments to anyone, you just went ahead and discharged all the debt completely, the waiting period for a Chapter 7 bankruptcy is 2 years from the discharge date. So if you had a bankruptcy that was discharged in October of 2021, we're now in November of 2023, you would be past the 2-year waiting period and be eligible based on that specific portion of your credit to qualify for an FHA mortgage. You wouldn't have to wait any longer. If you had a Chapter 13 bankruptcy, again, 2 years as well, but that's after you've been discharged from the bankruptcy. So you've made payments and now you've been discharged. Now, one other thing that's allowed with FHA mortgages in Chapter 13 bankruptcies specifically is that if you're 1 year into your payments on the Chapter 13 bankruptcy and your trustee gives approval, you can actually qualify for an FHA mortgage while you're still in bankruptcy. So just something to keep in mind. A foreclosure or a deed in lieu of foreclosure requires a 3-year waiting period. A deed in lieu means you gave your property back to the bank voluntarily, but it's still treated the same way as an actual foreclosure. Now, let's talk about gift funds. So a lot of people, when they're purchasing a home, may have some money to use toward the purchase, but not necessarily all of the money they need, or maybe they don't have any of the money they need, and they're going to be getting a gift from a family member or a close family friend, someone that's going to give you money toward the purchase of your property that does not expect you to repay them. That's the most important thing about gifts. They do not require repayment. If they require repayment, that's a loan, which you cannot use. You cannot have an unsecured loan, meaning it's not attached to anything, and use that toward a down payment on a property. So your option with gift funds is it needs to be something that does not require you to repay it. So if your parent is willing to give you money for your down payment and it's strictly a true gift, then we can utilize that toward the purchase of your home and qualifying. The most common gift donors are your family members, as I mentioned. It could be your employer or a labor union if you're part of one. And then a close friend with a clearly defined interest. So you need to be able to prove your friendship and your relationship with this person. It's very, very difficult to utilize a friend as a gift donor. It truly is, because it's hard to show that relationship and really, under this definition. A family member is the most common gift donor, and it's the easiest to link that to you as the buyer. Now, proof of gift funds. So on FHA mortgages, we need to not only show where the gift funds came from, but we need to show that the person who gave you those gift funds had the ability to do so. So what we're going to do is we're going to get a copy of the gift donor's bank statement. So if you're planning to buy and you're going to have a parent or someone give you a gift to help you with your down payment, they need to be aware that we're going to have to look at their financials as well, meaning their bank statement, to show that they had the money available to give you as a gift in the first place. They can't just all of a sudden have some deposit that we can't source come into their bank account and then give that to you, right? So we need to make sure they had the funds and were eligible and able to give you that gift. And now that money's in your bank account. So we need to show the transfer from their bank account to yours, whether it's a direct transfer or they gave you a check that you've now deposited and that check's cleared your account. We would get a copy of that check to go with it. The lender is going to provide you with a gift letter. It's a pre-formatted letter that you fill in the blanks with how much the gift amount was, what bank it came from, who it came from. Both you as the borrower and whoever the gift donor is are going to sign that letter, essentially saying that the donor does not expect repayment of those funds. They're strictly gifting you those, as I said, for the purchase of the property. That documentation is provided to an underwriter. They review it. and now those funds can be used as your down payment or closing costs, could be both, on your new property. But just keep in mind, whoever the gift donor is, they need to understand that they're going to have to provide documentation to support the gift. Now, let's just say you don't have a gift donor. You have your own down payment funds, but you don't have enough money to use for your closing costs, which are the other costs involved when buying a property. And if you want to learn more about closing costs, make sure to check out videos like this one that are specific to closing costs by subscribing. But let's talk about where you can get those funds if you're not using gift funds and you're using your own money, but you're a little bit short on the actual closing costs. That's where interested party contributions, or IPCs, come into play. First off, an interested party is someone who's involved in the transaction. The most common would be a builder on a new construction property, the seller of the property, could be the realtor, the title company, anyone who has a vested interest in the sale of the property that you're purchasing, or financial interest, I should say. Anytime they're going to give money toward the transaction, that's called an interested party contribution. And on FHA mortgages, you can receive up to 6% of the sale price of the property toward your purchase. Now, it can't be greater than your closing costs, but it can cover all of those closing costs. So here's an example. You have a $400,000 home. The maximum interested party contribution on that home would be $24,000. The reason that is 400,000 times 6% equals $24,000. That would be your interested party contribution that you're receiving toward the purchase, which on a $400,000 property, $24,000 would more than cover all of the closing costs. So you would really just be responsible in that case to come up with the down payment. And if you're getting gift funds and an interested party contribution, it's even better because you can walk into the home with none of your own funds. Gift funds cover your down payment, interested party contribution covers your closing costs. You're getting into the home with none of your own funds out of pocket. Now, what if you don't have an option for getting a seller credit, right? Or a realtor credit or a title company credit, an interested party contribution, where there's a way that the lender can actually get you a credit to help cover your closing costs, and it essentially allows you to finance your closing costs or a portion of them into your new loan. And the way that works is rather than taking the lowest rate that you may qualify for, you're going to opt for a slightly higher interest rate. And you might say to yourself, why would I want a higher interest rate? Everyone wants the lowest interest rate. And the reason you would opt for the higher interest rate is because that will allow the lender to give you a credit to go toward your closing costs. So as an example, if you qualify for a 7% interest rate, but that does not allow the lender to give you a credit, at 7.5%, you may qualify for a 2% lender credit. So if we were to look back at the $400,000 property, 2% of that is $8,000 that can go toward your closing costs that you now do not have to come up with on your own. And the thing to keep in mind is you can combine these things. You can get a gift funds, you can get an interested party contribution, and you can get a lender credit. The most important thing when it comes to the interested party contribution and the lender credit is those two things cannot exceed your closing costs. So no matter what, they can't go toward your down payment. The gift funds, on the other hand, can go toward your down payment and toward your closing costs. So that's what's unique about gift funds versus interested party contributions versus a lender credit that would be financed into the interest rate to allow you to cover your closing costs. They're all a little bit different, but as I said, they can be combined to help reduce your total out-of-pocket costs. So for more videos like this one, please subscribe. I have topics that you might find interesting regarding closing costs, more focused in on credits and how they work. So if you found value in this video or you have some questions about your specific scenario, please make sure to comment below. I do answer those. And subscribe for more videos just like this one.